I'm here, Hillary Kramer, at the Philadelphia Money Show with Dr. Allan Ellman, president of the Blue Collar Investors Corporation. Dr. Ellman, you specialize in covered call strategies. How can an investor determine what the best strike price is? How does someone who's starting out know where to begin for selling a covered call?
That's one of the biggest dilemmas that retail investors have. They have a stock, they love the stock, and they want to leverage that stock to generate income, but they're not sure which option to select. So here's how we do it. We first determine what's known as the moneyness of the option. Is the option price higher than the current market value, which is called out of the money, or lower than the current market value, which is called in the money? So as an example, let's say a stock is trading at 48. A $50 strike price would be out of the money, a $45 strike price would be in the money. Now, to determine which would be better, we first have to do a market assessment. Let's say we're in a pretty strong bull market.
Okay.
There we would go out of the money, so we would go higher to the 50. Why? Because not only are we generating option premium, but we're also allowing for share appreciation from current market value 48 up to the 50 strike. So two income stream possibilities in the same month with the same trade. Now, let's reverse it. Let's say we're in a bear market and the market is declining and we're concerned and we want protection. We sell the in-the-money strike. Why? Because the in-the-money strike has an intrinsic value component to it, which means we'll have more protection to the downside. Example, let's say the stock is 48, we sell the 45 call, the premium is going to include that $3 we're going to lose on the sale of the stock, plus an additional time value component, let's say $1.50. So the premium will be $4.50, making our break even from 48 down to $43.50. So although we're giving up upside potential, we're gaining downside protection. So in bear markets, in volatile markets, if chart technicals are mixed as opposed to all bullish, I would lean towards in the money. Now, the specific strike can also be determined by making an initial time value share profit determination, let's say 2 to 4%. And let's say you decide it's bullish, you want to go out of the money. You look at the options chain and you see which strike is going to give you between 2 to 4%. Bingo, now you have your strike.
Okay, and how does an investor utilize covered call strategies? Is it owning a stock for a long period of time because it is inherited, or a person worked at that company and just has so much stock? Or is it that you have underlying stock and write covered calls to increase your income? What do you see as the different reasons to employ that kind of strategy?
Well, all the above. If you have a portfolio of long-term buy and hold stocks, perhaps at a low cost basis, perhaps in a non-sheltered account, the risk with covered call writing is your shares will be taken away from you, and you may have some negative tax issues. That can be avoided, and that's one of the things I teach. So you would only go out of the money, and your goal would be much lower. Let's say you want to tack on an additional 6% to your already generating 8 to 10% portfolio. 6% means 0.5% a month. Out of the money. So you go to an options chain, out of the money, which strike is going to give me 0.5%, and that's your strike price. So if you're doing a buy and hold, that's how you do it. Now, if you do it the way I do it, traditional covered call writing, your portfolio is going to turn over 20 to 80% every month.
Got it.
And then you could be more aggressive, you can go with growth stocks, and you could reevaluate your bullish assessment every single month.
How can viewers get in contact with you? What's the best means? What's your website and your contact information?
The website is www.thebluecollarinvestor.com, and you could reach me directly by email at allan@thebluecollarinvestor.com.
We have been speaking with Dr. Allan Ellman, specialist in covered call strategies, and we are here at the Philadelphia Money Show.